This is the series where we look at price action candle by candle, and this is the second video that I'm putting together in this series, just to help you understand price action in a simplified way, because price action or looking at a price chart seems to be quite complicated to most people. So I've decided to simplify this. You'll be able to develop a perspective of the market, can be able to develop a bias, and even develop a trading idea. So let's get started. Now we're going to cover a few areas that are very vital in reading price and reading candlesticks. So one of the things that is important is to identify areas in the market or the zones in the market where large institutions are willing to put big transactions in the market. Liquidity areas are areas where your orders will be executed immediately. And for people who are placing very large orders, definitely not retail traders, but institutional traders, these are the zones where they're able to take large positions. And we're going to look at how to identify or exactly where these zones are in the market, because if you know where the zones are, you can be able to get involved. The other thing is we're going to look at how to establish a daily bias, how to develop higher time frame context. Without context, you're likely to come up with trade ideas that are not aligned to the higher time frame, and those are not high probability setups. So let's start with liquidity zones. Personally, I look at these three areas, and these are enough for me to identify liquidity in the market. So the first thing is price imbalance. Then the other thing is price swing low or swing high, a point where price makes, and finally supply and demand zones. In this video, I'm going to cover in detail supply and demand zones and how to identify them. If you need to understand more about price imbalance and swing points, then you can go back and watch the video. It's the first video in this series. Now, let's go to the chart so that we can go through this. So this is a daily time frame, and if you're a day trader, then you can start your analysis on a daily time frame downwards. So personally, sometimes I go for a monthly time frame analysis, especially at the beginning of the month, just to have a perspective of how the month would look like. And more frequently I look at the weekly time frame, but on a daily basis I look at daily time frame, 4-hour time frame, and minimum 1-hour time frame. Sometimes my trades go into swing because 1 hour, 4 hour, and daily are higher for those who are scalping. Because if you're scalping, then you would go for 1 hour, 15 minutes, and sometimes even 1 minute. Some people scalp below 1 minute chart. Let's look at price action around this zone in the market. We have a swing high at this particular point, and definitely we know that swing high or swing lows are key points of interest in the market, and we consider them liquidity zones. So a swing point like this one is a liquidity zone. We have another one here. So price printed and created this swing high and then started moving down, and we can see that there's a little bit of consolidation here, and then volatility came in, and we have an expansion lower that expanded below this swing point here. So we have that break, and a candlestick has closed below. Then the next candlestick is consolidation, that is leaving us with a gap, which is an imbalance. And we can see that after that, price has broken below this swing low and created another imbalance at this particular point. So these are some of the areas where you'd want to be interested in, especially when price comes back into these zones. And we've had a little bit of consolidation and then another expansion lower, leaving another imbalance here. And we can see that price has come, filled the imbalance, and traded lower. And we realize that either momentum slows down when price gets into that zone, or it breaks through. That is when the candlestick closes below. For example, this swing low is a key point of interest where we might expect a rejection of price to continue higher. But in this particular case, the daily candle has closed below the price level. So this swing point is a liquidity zone, and we also have another swing point here that we've had a slight rejection of price, but then later on price has broken below. Now that brings us to the idea of supply and demand, because when price moved with a lot of momentum lower after breaking this level, this zone becomes an area of supply. So I'll just clear this so that I can mark out the supply zone. What I do is I mark the body of the candlestick that has created the supply, and then this becomes my supply zone. So the whole of that is a supply zone. We qualify this supply zone with this imbalance here, and this one also further qualifies the supply. This imbalance that we have also further qualifies the supply. So this becomes a supply zone, and when price comes back here, we expect institutions to get involved, and this is likely to either reject price lower with momentum, or if price breaks above this point, then it would move higher with a lot of momentum. So now this would not be a good supply zone because there is no imbalance that has been created below as a result of price moving away from that zone. Now another supply zone is this one here, where we have this bullish candlestick that has been followed by aggressive sell-off, leaving imbalance in this particular zone here. Now this imbalance here qualifies this supply zone, and this is a key point of interest where we would want to look at how price is going to react when it comes back to this particular zone. Now we also have another supply zone here. We mark it from the body of the candlestick that created the buy within the zone before the sell. So we have a bullish move before the bearish move. Now the bullish move is consolidation with manipulation, where we have this high here taken by that wick, and then price has moved lower, leaving an imbalance. And if price moves higher into this supply zone, then we expect price to continue lower. But if price breaks above this supply zone, then we expect price to move to the next zone high here. Now we're going to look at the chart with examples where price has either gained momentum through the zone, or there's momentum loss and an expansion in the opposite direction. So if you look at this price action, we have a swing low created, and price has moved higher, creating an imbalance. So right from this point, price came to this swing low, followed by a day of consolidation, and then the next day we have an expansion high. So price has expanded above that level there. Now if you look at the price leg between this swing high and this swing low, we have an imbalance, and price has come into that imbalance zone and then moved higher, breaking the swing high price level up there. So this is significant because this imbalance has become an area of liquidity where price has drawn liquidity to move higher, and we can see that price has broken above this swing high, closing above, and after that it has continued higher. So this is a decision point where, because price has respected this zone here, which is a liquidity zone, an imbalance, and broken above here, that gives us a bias that price is going for this high here. Now that takes me to the next point in our study, where we're talking about daily bias. Now we are on a daily time frame, and therefore the bias that we establish either on daily time frame or 4-hour time frame, we would consider that higher time frame bias. That is what we need. We need higher time frame bias so that we can later on establish higher time frame context, or where we can develop high probability trade ideas. So basically, bias is being able to tell with some level of accuracy or high probability the next draw of liquidity based on the current price action. And therefore, look at this price action here, where price has drawn liquidity from an imbalance below, which is our liquidity zone, and broken the high and closed above. This gives us a bias, and if price is having a bullish bias, the next draw of liquidity is going to be this swing high or this supply zone. I would consider this a supply zone because we have price create an imbalance just below before it moved low. And we can see that the next day traded into the supply zone and then continued higher into the swing high. Now, at this point we have a bias that price is coming higher, and that is our next draw of liquidity because of the bullish biasness that has been created by price action by this set of candlesticks to trade bullish in the following days. Now, there are cases where you would find the bias is not established at a daily time frame, and in that case you would go to a 4-hour time frame so that you can be able to establish the bias. When price gets to this level, we are not sure whether we are going to have momentum loss or momentum gain. But then with the following day we get a momentum gain above this level. And therefore, the following days we are having a bullish bias because after interaction with this liquidity, price has broken above, giving us a momentum gain with expansion. So the point here is we want to see draw of liquidity with momentum gain or loss with an expansion in the direction of the gain or in the direction of the loss. For example, price has moved higher, leaving an imbalance, and then price has come into that imbalance, but then we have a loss of bearishness where this candlestick has closed outside the range, and then an expansion higher where the following day has expanded above this range and closed high. So that gives us a bias, and we can be able to trade with the bias upwards. Now at this point, at the close of 20th of August 2024, we don't have bias because we've reached draw of liquidity, which is the swing high. But then if we want to trade the following day, which is on 21st, if we want to trade on 21st, then we would want to get a bias, and we don't want to wait until the end of 21st for us to trade. So this is the case where we go down to 4-hour time frame. I'll just mark this so that we can be able to see how price has interacted with this liquidity. We want to see draw of liquidity, which has already happened on 20th. And then the next thing is we want to see, is there momentum loss or momentum gain? We have a bullish momentum, and on 4-hour time frame, are we going to see a momentum loss or momentum gain? And then is the expansion going to follow the gain or the loss direction? So I'll just move to 4-hour time frame, and let's move to the... So here's where we are on a 4-hour time frame. Just zoom in. I like zooming in so that I can read the candlesticks. So in this case, I'm not depending on structure, but I'm depending on candlesticks. So I won't really consider this momentum loss, because for me to have a momentum loss, I expect this 4-hour candle to close below the body of this particular candlestick. So this is momentum maintained because the following 4-hour time frame has just consolidated, and then we can see that price is continuing to push upwards. Later in the day we can see that price has given us an expansion high, and this expansion higher gives us bullish bias, and therefore the next hours of the day we are looking for bullish trade opportunities. So just to go through this again, price has come into this liquidity zone, which is a swing high, and we haven't had momentum loss because instead of having a reversal signal where the candlestick closest below, or this candlestick closest below the candlestick that has interacted with the liquidity, that has drawn liquidity, instead we are still having bullishness in the market. But at this point we don't want to confirm the buyers until we have an expansion high, and therefore the expansion above that zone there, that swing high, gives us the bullish biasness for that particular day. So like I said, we can confirm this on a daily time frame, or we can confirm this on a 4-hour time frame. Now those are the two time frames where we want to establish bias, because below that would be lower time frame, which is 1 hour that we would use to enter the market. If we are having a bullish bias, then we need a discount drove liquidity, or we need discount liquidity at fair value at a point where buyers would get into the market, because buyers would want discount for them to get involved. If you look at this price action here, we've had a bullish price move with an imbalance, and you can see that price has come into that. Consider this a fair value, discounted enough to continue higher. Now I'm going to combine liquidity buyers and higher time frame context. I'll just clear that. I'll clear the chart. So I'm going to look at other areas and price so that we can have this. So this is on a daily time frame, and if we start with this, we have price break below this swing low and closest below. So if I mark the beginning of the following day, I would want to get a context. I already have a bias by the break and expansion lower that price probably is coming to the next drove liquidity, which is that swing low there. But I need to develop context. I need to identify a premium fair value zone where sellers would come into the market to push price lower, because you can't just enter on this daily candlestick. You want to enter on a hourly time frame or a 4-hour time frame, which is a lower time frame. Now if we look at this on a daily time frame, assuming that the price action on 2nd of October hasn't happened yet, so all we have is everything on the left. We'd want to develop context on 4-hour time frame, because we don't have a context on 1-hour time frame, or we don't have imbalance yet, because this is the only candlestick we have. So we don't have an imbalance, and we want to come down to 4 hours so that we can identify a fair value area at premium to push price lower. So if you look at this, before the open of the new day, price has given us an imbalance on 4-hour time frame. So we have this, and we also have this one. Now either of these can be considered premium enough. So if price doesn't consider this premium, then it would come all the way to that point, or it would come into the supply zone. So I would mark this with a a different color. So we expect price to consider this premium enough and fair value to push lower, or that or that. So in this particular case, we can see that price has come into this first imbalance, and then we've had momentum loss. So this bullish momentum, we've had significant retracement. Now, this forms our price higher time frame context. So we consider 4 hours higher time frame. This gives us a higher time frame context where sellers can come in to push price to the target down here. So before this candle prints and this one prints, and even the price action in the right happens, we already have a context area where we can enter the market. And remember, we don't just enter the market, but we wait for confirmation, alignment, and we also want to understand time when we expect liquidity into the market, something that we are going to cover in the following videos in the same series, because we need to know which time to enter the market, especially when we expect liquidity. I'm going to go back to a daily time frame so that we can look at another example. So let's again zoom in and now consider this price action, and on a daily time frame we can see that price has consolidated around this zone, then broken below this swing low here. But on the long term, we can also see that price has also closed below that. Now this gives us a bearish bias. So after this, all we are looking for are opportunities to short the market. You don't want to become a buyer in this price condition, because if you start looking for buy, then you are trading again as the buyer. So we already have a daily bias, but then now we want to look for a context, and we can see that on 18th of October, we already have price imbalance. Mark this with so we already have price imbalance, but we also have a supply zone here. We also have a supply zone there. Now on a daily time frame, we consider that context, because if we are bearish in our bias, where do we have premium liquidity at fair value where we expect sellers can come into the market to push price lower? The zone is either this or that. So if price breaks above this zone, then the next zone that is likely to be premium enough for sellers to come in is this one. So this gives us a context. So we have the target. In this particular case, let me just zoom out so if we zoom out, then when price breaks below this swing low, the next drove liquidity would be either this gap here, or if price breaks below that, then it would come all the way to the demand zone down here. We can see that that is exactly what has happened. So I'll mark this with a different color. So we have this as the first target, second target, but then we have this as the context, premium, fair value zone that we can have sellers come into the market. So when sellers are coming in as a retail trader, you also come in into the market at that particular point. Now, how to get in is not within the scope of this video. And if you have an entry model, you can use it. But later on, I'll also cover entry models and how to read price alignment to these buyers within the context area on a lower time frame, which in our case will be 1 hour. There are people who enter the market on 15 minutes, but personally, because I read candlestick and not structures, I'm comfortable with 1 hour time frame. So this forms the end of this video, and if you haven't subscribed to this channel, please subscribe, share this, and let me have some of your comments, some of the things that you would want me to cover. If there's something that you haven't really understood, I can always revisit that. Like this, and see you in the next video.